All right, everyone. Welcome to the 189th episode of DoubleLine Minutes. I'm Sam Lau here with Mark Kimbrough.
Hey, hey.
Hey, Mark, it's just after 10 a.m. Pacific here on November 1st, 2024. A lot to talk about this week on the macro front. It's a big, heavy week next week as well. Before we get into it, do you have anything you want to unload off your chest about this week's past events that doesn't necessarily involve markets?
Hey, thank you very much. I'm just going to say, go Dodgers. Sorry to Yankee fans out there, but better luck next year. And yeah, it was a fun series, fun season. But now fall's with us, and I just taking it in still. But it was a fun time. But thanks,
Yeah,
man. I
yeah.
just want to say, go Dodgers.
Absolutely. I mean, it's interesting to see, and hopefully, there's no asterisks around, behind this the 2024 year this time. But since we're in LA, you gotta say go Doyers as well.
Go
Um,
Doyers.
we do have the parade as well. Just I don't know what time it started or starts or will be starting, but that's just going to wind right by our offices as well. So pretty exciting.
Yeah, I was tempted to drive in this morning. I think it kicks off around 12:30, but they're saying a lot of downtown is going to be on lockdown. So yeah,
Yeah,
didn't make the journey.
after some of the videos that you saw around, some of the darker side of the celebrations here in Los Angeles, that's probably it's prudent, I suppose. It's good risk management, I suppose. But with that, let's jump into the markets here. What I've got going on for the week to date right now is the S&P 500 is down about a point. It is, we are going further into earnings seasons. There was a couple disappointing not necessarily prints, but forward-looking guidance, I suppose, in terms of what people should expect from the tech sector, particularly around the AI. I mean, I think people are starting to realize that AI comes with a cost, and that cost is it's a heavy capex type of venture, across a number of different sectors and a number of different industries in order to get there. So, with that on the week, alongside that, down a point so far in the S&P 500, technology is down about 2.5%. That's the big loser on the week, and that was some of the big dip happened yesterday, if memory serves, and where the tech sector was down about 3.5% just on that day. So it's kind of reflective of what we saw in some of the earnings disappointments this week. Alongside that, also in the down two handle for the week to date is real estate. That's down just a little bit less, down 2.4% right now. But on the flip side, we have one positive performer on the week to date basis. That's comm services. And I should say that's firmly positive at 2.3%. Right now, we've got financials up about 20 basis points on the week. So we'll see how the rest of the day goes. But those two are the only positive performers right now on the week to date basis for the sectors underlying the S&P 500. On a year to date basis, we still got about a 22% positive return on the S&P 500. So just a little bit more wood to chop for the remainder of 2024. But it does. I'm going to go out on a limb here and say that it looks like the S&P 500 could end the year with a positive sign in front. But we do have a lot of news coming out next week as well. So we'll see how things go. I mean, certainly the market has been jittery around next week's election on Tuesday, and then whenever the results actually come out. And then, of course, on Thursday, we have that FOMC. So there's a lot of uncertainty in the market that, hopefully will be cleared up in the next week or so. But with that, moving over to bond land, we'll start out with the treasuries. And right now, across the curve, I see rates higher, starting out with the 2-year note. We've got the 2-year treasury yield at 4.17 right now. That's 7 basis points higher than where it ended last Friday. Moving out the curve to the 10-year, that's at the yield of 4.34%. So that continues to push to new local highs, I guess, if you will, within this context of the last few months here. But that's up 10 basis points in yield on the week. And then for the bond's up 4 basis points in yield to point right now we're at a yield of 4.54. So what that all means for the broader bond complex as measured by the U.S. Bloomberg aggregate, that's down about 40 basis points thus far on the week to date basis. Still trying to hold on to this positive return. For the year, right now it's at 1.7% positive performance on the total return basis for 2024. Pretty much everything in the red right now. Leading the way down is IG corporate credits. That's down 60 basis points, followed by agency mortgage-backed securities down 50 basis points, and EM just about 45 basis points down. U.S. Treasuries down 40 basis points. And then when we take a look at the below investment grade cohort here, high U.S. corporate high yields as well as bank loans are pretty much just flat on the week at this point. Rounding it all out for a negative week-to-date print across these asset classes that we look at, commodities no different. That's down 2% on the week. On the year, it's holding on to this positive return of about 4%. But really, when we take a look at it across, energy just got pummeled this week. Right now, when we take a look at WTI front month futures here as the proxy, that's down over 2.5%. That pushed the year-to-date number down a little bit lower as well, in line pretty much at down 2.5% as well, give or take. Earlier this morning, I saw that WTI was managing to hold on to the $70 handle, which I was a little bit surprised about just based on what we've seen over the course of the week. But right now it's hovering just 10 cents below that $70 a barrel front month crude oil futures. But the one kind of shining star thus far for not only the week, but as well as the year is gold. Your favorite asset right there, Kimbrough. The shiny metal there is up 40 basis points on the week-to-date basis, still shy of its all-time high of 2,800 a troy ounce and some change there. But right now it's at $2,751 a troy ounce, up on that front month contract. Price return up almost 33% on the year-to-date basis. So with that roundup of the markets this week, Mark, do you want to kick us off on this busy week that we had in macro land?
Yeah, let's get into this. Use a term we like to use. Let's strap in here because we do have quite a bit to go through. Let's see. Let's start off on Tuesday. We had S&P Core Logic, the 20-city month-over-month measure for August. This is home price and generally, hopefully, appreciation. That came in at positive 35 bips. That was 15 bips higher than estimates, and an acceleration from the prior of 0.25%. This helped bring the year-over-year measure to 5.20%, deceleration from a prior 5.93. This month we had to contend, at least the year-over-year number had to contend with a 1% handle roll-off, so not surprising to see the year-over-year measure decline. We're still getting strong HBA. These numbers are still firm. I will say that the number I said for month over month was seasonally adjusted. On a non-seasonally adjusted basis, it was down 32 bips. We're passing the home buying season, so is where it is. But thanks for the seasonal adjustments. Moving forward on Tuesday, we had the JOLTS job openings for September. This was a weak report. It came in at 7.443 million, about 550K under estimates, and about 400K under the prior. That prior was also revised down. Looking at this, we like to look at the job openings unemployed ratio. That came in at 1.09 versus a prior of 1.10. But to give that a little context, and I'm spewing some decimals here, but we were 1.08 back in July. What I'm trying to say with that is we spent about 3 months without a ton of movement in this ratio, and that's about the level that's, we'll say it's a little below where we were pre-COVID. So let's see if we can gain our footing here or if this metric resumes its fall. But all in all, the JOLTS job openings report was a weak report. Not going to dive much into the details there further than that. Also on Tuesday, we got the Conference Board Consumer Confidence Report for October. This came in very strong, at least that's what the headlines were saying. It came in at 108.7. That was 9.2 points above the prior and 9.5 points above the prior, 9.2 above the estimates. I want to give this also a little context. That prior was sitting near the local low of the year. So this bounce we had, it puts us right back in the context we were in August. I'm going to say these measures are kind of range bound and noisy. Great to see an improvement, but rather see an improving trend. So I'm just going to say nice to see good numbers on the consumer confidence front or an improvement, but let's line up a couple more of those reports. On Wednesday, we had the ADP employment change for October. This turned the page from prior day. This was 233K. That was 122K over estimates and 74K above the prior. It's the highest print we've seen on ADP since July 2023. Um, all that being said, today is Jobs Friday. I'm not going to front run what we're going to talk about for Friday's economic data, but we take this report as with a grain of salt. It's supposed to be an early look to the NFP. There's other data you can glean from it. I mean, most of the job growth was in the service sector, more so than the goods. It was more so with large companies rather than small. But you know what? We like the report, like to take a peek at it, see what they have, but we kind of focus on the one that comes out on Friday.
Yeah, I mean, the peak is the right word. It's like I rarely look at it beyond the headline, on that. In fact, maybe Aaron and I did a dive into the differences between the ADP and the NFP and why the numbers come out so different. But I always thought I guess humorous is a little bit strong, but it was one of those things where the ADP at one point, maybe they scrubbed it, but their stated goal was to front run. They didn't use the word front run, but they said to match and anticipate what the NFP would be just by a day or two in front of the NFP report. So for me, I feel like I can have patience when it's due, and especially if I'm getting what is to be the actual data print that you're trying to match. I could wait 2 days for the NFP report without trading or even thinking about the ADP as reflecting within my investment strategy.
That seems like the safe choice. I mean, that's well said. Can't say better than that. So let's move forward off that data point and go to GDP. On Wednesday, we had the third quarter advance estimate, the annualized Q over Q number, came in at a strong 2.8%. That was 0.1% below estimates, 0.2% below the prior, but I'm still going to say strong, it's firm real growth when you're at 2.8% real. Let's break down the components of this. You got the top, the primary four components, or the four ones that add up to the 2.8. I'll cover this on a contribution basis, actually. We're going to do personal consumption. You got just shy of 2.5% coming out of personal consumption, the engine of our economy. Gross private investment kicked in 7 bips. Net exports took away 56 bips, and government spending contributed 85 basis points. So, I mean, look, the things that stand out clearly, personal consumption, that was the strongest contribution we've seen since Q1 2023. Look, the data we've gotten throughout the quarter, you think about it, even though labor market is slowing, we still have firm wage growth. We still have there still is job growth in general, and consumers are not afraid to tap their credit cards. We've seen on the spending data. So consumption persists. On the other side of that, again, government spending with an 85 bip contribution, that's the strongest contribution we've got there since Q3 of 2023. So, yeah, I think that's the bulk of our GDP this quarter was the government spending and the private sector spending. So everyone's doing their job.
Yeah, it was one of those reports too that. Sorry to cut you off there, Kimbrough.
No,
okay, so I was going to say that it was one of those reports where we looked around and looked at the report, looked around at each other on the desk, and said, come out with what's the negative in here, right? It's hard to find the negative, at least from the reported numbers. Sure, you can say maybe consumer spending is being driven by credit and debt there, but on the government side, picking up the equation is especially in this type of deficit spending, that environment that we're in, is never a good thing. But overall, I mean, you look at these numbers on a real basis, it's quite strong, and it's one of those times where we're waiting for the bears to come out, right? Just like we couldn't find the negative spin on ourselves, so we said, okay, let's wait for the usual bears to come out and put it out on the X, and we'll get that spin, and that never came out. And so we looked to our own internal bears, and our internal bears were noticeably quiet as well. So it is one of those things that you take a look at, and it's quite strong, given that this is just the advanced report for the third quarter. And what is it? There's 3 or 4 revision periods that come out over this time.
Over the 3-month period, you get your standard one revision each month. So your advanced, your second, and your third, and then there are the periodic adjustments that are still done. But it's the 3 is the main ones we look at.
Yeah, that makes sense. And then the final comes out when the fourth quarter, or when the next quarter is preliminary comes out. So I mean, take it how you will, but there's many a slip betwixt the cup and the lip, right? So that with those 3 revisions that come out, we'll see how that goes as more data comes in.
You know what I did? I was trying to scratch the surface. I still was digging a little bit on the negatives, and I came up with a couple for you. And
let's hear them. We got to hear them.
So you know what? We can always look. Net exports, we'll set that aside. We run expanding trade deficits on occasion. Those numbers can be noisy, so that is what it is. But we would like to see a little firmer investment. The gross private investment contribution of 7 bips. Like it's that's the pipeline of future growth, what you're investing in, and that's would love that to be a little stronger. We've had back-to-back negative quarters of residential construction. That's not a positive thing. So I shouldn't say residential construction, residential investment.
Investment. Yep.
But so I mean, look, that's what I could scrape off the surface there. That's or I should say digging a little deep. Those are the two
All right.
little. So I'm gonna leave it there. Let's just say that's
Wave
it's
it
a
in. We'll
strong
take it.
quarter. Yeah.
Yeah.
Moving forward to Thursday, we had the employment cost index for the third quarter. This came in at 0.8%. That was 0.1% below estimates and 0.1% below the prior quarter. This data going back to Q4 1996, we've averaged a quarterly print of 74 bips. So I'm going to say this 0.8%, we get them on a rounded basis like that. I'm saying we're in the context of normal. And you don't want to take one data point and just say that's, I don't want to say one data point's a trend, but this is one data point along a trend of slowing data. And that's the disinflation we've been seeing. So I'm going to say this was another encouraging print, something that's showing, we're making progress on the pace of disinflation. And wage growth is still firm. If you look at the year-over-year numbers, you're 3.9% on a year-over-year basis on this figure. So again, it's decent printed. Also on Thursday, you got personal income and personal spending for September. We'll start with income. That came in at 0.3% month over month. That's right in line with estimates and a slight acceleration from the prior month. The 20-year average for this for personal income is 0.4%. We came in a little below it. But year over year, we're right at 5.5%. On a 6-month annual basis, we can see a little deceleration. That's growing at 3.9%. You're getting basically 3/4 of that from wage growth. Another quarter of that is coming from transfer payments, and then the rest kind of washes out. But personal income persists. I mean, it's again, you see that in the spending numbers, which came in at 0.5% for the month of September. That was 0.1% above estimates and 0.2% above the prior month. But split between goods and services, you get about a third spending in goods, 2/3 in services. Both grew at a rate that was above 50 bips. Got 54 bips for goods, 53 for services. So that's how you get your 0.5% on personal spending growth. In general, you get a little more volatility in good spending. It's nice to see a good month there, but services has been persistent. And to give some more year-over-year context for this, 20-year average year-over-year spending is 4.59%, and we're at 5.06% now. So I'm going to say spending remains firm, at least for now, or in the rearview mirror. Also on Thursday, we got PCE data, usually extremely accurate relative to estimates. The headline month-over-month number for September came in at 0.2%, again in line with estimates, and a slight acceleration from the prior month. That brought the year-over-year number down from 2.3 to 2.1%. But more importantly, we get core PCE. That came in month-over-month at 0.3%, in line with estimates, and a slight acceleration from the prior month. We ended up not getting a change. Both year-over-year measures declined, but we didn't catch the round for the core number. That was unchanged at 2.7 versus estimates at 2.6. I'll give you some precision here. We had 2.72% on the prior, 2.65 on the current, so both around 2.7. Closing out the year, the roll-off figures are not exactly pretty. We got 0.13%, 0.09%, 0.18%. So possibly not a whole lot of progress to be seen on the year-over-year front for core PCE, but it's been a good year so far on the disinflation front. Starting to wrap this up, we got initial jobless claims also on Thursday for the week ending October 26th. That came in at 216K. That's 14K below estimates and 12K below the prior. And we got continuing claims the week ending October 19th, coming in at 1.862 million. That's 18K below estimates and 26K below the prior. In general, look, I've been talking about this for the last few weeks. Hoping to see some of the storm effects start to wash out, no pun intended. And we're seeing it here. So we'll give it a couple more weeks, see how it goes, but it's nice that these are coming off their peaks. That brings us to Friday, aka Pizza Friday, Jobs Friday. It's a fun Friday. We got NFP. That was not a fun print, though. That came in at 12K, 88K below estimates, and 211K below the prior. Nothing close to our ADP report. It's the lowest print we've seen since December 2020. But again, the October, we're still dealing with a little bit of storm effects. I'm just going to say that this is a noisy month. Let's hope that this clears up in the months to come. I'm sorry.
Sorry, before you go into the U3, I mean
Yeah,
the payrolls estimate. I always kind of scoff at estimates just because I've mentioned this in the past. I think a lot of it is just economists putting their fingers in the air, and just trying to gauge where the wind's going to blow next, right? But
yeah,
I felt like this 100K estimate was kind of garbage, in the context of I saw a lot of economists coming out and saying that their expectations was that there would you have to fade this particular payrolls report by 150K because of what you just mentioned, because of the effect that the survey came in right around the period that overlapped with many of these storms that we just had, that we just underwent. That and the fact that they knew that the Boeing strike, there's about over 30,000 workers that weren't going to be receiving payroll that week. The fact that they came out with a 100K estimate on top of that, it just seems absurdly high to me, especially in the context of recent prints on the NFP as well. When I was looking at that, and if I were to take that 150 into consideration, I was actually thinking yesterday that maybe might even see a negative non-farm payrolls report number come in. But certainly not something like 100K, on
yeah.
top of what people were talking about there. So I
Well, you
don't
know
know.
what? Oh no, so I was saying on that note, let's give it a little time because I mean we just got 2 month net revisions at negative 112K. Well, I mean that's been the trend in general over the last year and a half. Is well, last month we had positive net revisions. That was kind of an outlier. Would be surprised if this thing potentially ended up going negative. It wouldn't be out of character for the state as of late. So I
Yeah.
totally hear you on that.
So it's one of those things that hopefully, market participants are kind of fading this current payrolls report, which it does seem like they are, a little bit. But again, it's hard to tell with all the uncertainty that could be cleared again up with this next revision with on the payrolls, but also what's going on in the next week. So just kind of,
Yeah,
I mean, my take is just kind of fade this report.
I think that seems like a very sober take. So let's, you know what, wrap up our Jobs Friday. We had the U3 rate coming in at 4.1%, unchanged from the prior, in line with estimates. That doesn't sound like that jives with what we just was seeing for the NFP report, but that's explained by the labor force participation rate. That declined to 62.6%. It was a 10 bip decline from the prior and below estimates. I mean, looking at the underlying data, you had the population increased by 209,000, at least the way we create these estimates or these numbers. But the labor force declined by 220K. So, I mean, that's you didn't have people weren't just flying into the employed pocket. We had 368,000 job losses on the employed side, while the unemployed only increased by 150K. So you have people leave the labor force, the unemployment rate gets a little help to be able to stay flat. Again, we're 4.1%, still not too high, but we'll see how that continues to progress. And fading this report in general, let's see where we get in November. And then lastly, Friday, we have ISM manufacturing for October. Came in at 46.5, 1.1 points below estimates, 0.7% below the prior. Weakness persists in ISM, in manufacturing. We've had 7 consecutive prints below 50. Looking under the hood for all this, all of the demand components are in contraction. All of the consumption components are in contraction, thinking production, consumption of resources, both human and capital. And prices actually bounce back into expanding mode. So this is just, I guess the prices maybe is a positive from I guess prices maybe can be the only thing spun as positive here, but we don't want to see rising prices. So manufacturing continues to be just in the doldrums. It's chugging along and it's contracting. So we'll see when that ends. There's plenty of anecdotes in the report getting hopeful comments 2025, but it doesn't, nothing speaking too well for the rest of the year on the manufacturing front. And that, thanks for hanging in there, but that wraps up the week.
Yeah, definitely a busy week. So thanks for leading us through that. For any of the listeners out there who have, any questions on, on some of the stuff that Kimbrough was talking about there and want us to take a deeper dive as a potential topic of the week, don't forget you can go ahead and sling them into us via our X or emails, which we'll talk about, which I'll give out at the end of this podcast because I can't. Well, actually, I'll fast forward to it now. It's our minutes at DoubleLine minutes, or you can send us the email at minutes at doubleline.com. But with that, moving forward, Fed speak, quiet week, blackout week, so nothing the Fed doesn't say, is blackout period before next week's FOMC meeting in terms of what the market is predicting or is putting in terms of the probabilities for Fed fund via the Fed funds futures for the FOMC meeting coming on next Thursday, 11/7. Right now, it's pricing in a 25 basis point cut, pretty much fully. For the remainder of the year, it's also pricing in one other cut. Right now, it's 81% probability, or 82%, let's say, probability of a second or another 25 basis point cut at the December 18th meeting. So that's kind of right, or that is right in line with what the Fed had indicated as what the number of cuts that we would see in 2024 at 1 percentage point of total cuts for the year. In terms of the things to keep an eye on next week, we've got ISM services on Tuesday, but right now the estimate's coming in at 53.5, so still firmly in expansionary territory despite being a little bit lower than the previous period of 54.9. I'm sure all that's going to be overshadowed by what we're going to find, what we're going to start on Tuesday with the elections. And then on Thursday, we should have some information on what the FOMC is actually going to do with their monetary policy, both from the rates and perhaps from the balance sheet side as well. But right now, it's expected to go from an upper bound of 5% where we are today to 4.75% on the upper bound. That should be an interesting presser. I mean, the market participants are going to be looking to see what the Fed, see if there's any clues out there on their forward-looking guidance, especially at the back of the election. I'm sure there's going to be a lot of questions that they're going to try to sneak in for Mr. Powell around, his thoughts about the potential new administration there. And I hope his answer is going to be, no comment. It's nothing to do with us. But we'll see how he handles it, and we'll see what color tie he has. But that pretty much wraps it up for this week, Mr. Kimbrough. We do have a lot of things out there on the media front for folks to peruse if they're interested. I highly recommend. We have Jeffrey Gundlach, who was speaking at the Buffalo AKG Art Museum earlier this month. We have a YouTube video posted on our YouTube page there that went up about 3 days ago. And then also just in time when it came out yesterday for Halloween, we have portfolio manager Stephen Wald speaking with client portfolio manager Phil Joya on the latest episode of Perspectives, and that one is titled "The Rise in Yield, U.S. Treasury Yields. Is it a trick or treat? How should we thinking about your fixed income investments there?" And then I got a reminder from Mr. Jason Ferrent to let people know that on the YouTube channel, when people are watching our videos there, especially around the minutes, they can refer to the timeline that accompanies the videos to take a look at the charts that on some of the data that we discuss here on the minutes, so they can get a visual along with this audio that they're picking up. Then moving forward, we also have a new article out by our asset-backed securities team. It's talking about the data centers, especially around the AI evolution, I suppose, and it's titled "Securitizing the Digital Present and Future," and that can be found on both our LinkedIn page as well as DoubleLine.com. And then finally, wrapping up this media download here is that we'll have Jeffrey, of course, on CNBC with Scott Wapner on Thursday, right after the Fed speaks, shortly after the close. I can't remember exactly what time, but you'll check it out. You can find out that time on the CNBC. I was going to say, I think it's shortly after the close or right at the close there, but check it out on CNBC. And then we'll also have Kenny Shinoda on Bloomberg on Fed Day as well, both following the presser there.
Yeah, so you know what? Thanks to all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yep. And as I mentioned before, you can send us a topic of the week suggestion via the email as Kimbrough just mentioned, but also don't forget to subscribe to our YouTube channel there at DoubleLine Capital. Want to thank everyone for tuning in and hope everyone has a great weekend.
Yeah, thanks, and go Dodgers.